This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 93.1 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans, or you can talk to him right now at 407-916-5400.
Well, good morning, ladies and gentlemen, and welcome to the program Dollars and Cents. My name is Joel Garris of Nelson Financial Planning, and for the next hour here on News Radio 93.1, we'll cover a variety of topics, ranging from how much you'll really need in retirement. A lot of general rules of thumb on that question. We're going to tell you why those general rules of thumb may, in fact, be overlooking some important items. And then we'll spend a little bit of time talking about a topic that we did not get to last week, some of the stuff that's happening in Washington, or some of the conversations, not really actually happening because, well, things in Washington don't happen very often. Lots of things happen, but they don't actually do anything. There is a lot of conversation in Washington about making various changes to particularly 401ks this year. And then we'll provide some international global perspective, may even talk a little bit about talking devices, some interesting investment and, frankly, life implications on those. So those are the topics that we've got teed up for today. Always willing, though, to add your topic or question as well to the program. So if you'd like to chime in and bring your topic to the table or your question, we would love that. And all you need to do that is to pick up the phone and dial these numbers: 407-916-5400, toll free 1-866-916-5400. Or you can, if you don't want to get on the air, you can certainly send us an email directly. That email is Joel, Joel, at NelsonFinancialPlanning.com. Of course, Nelson Financial Planning is where we are Monday through Friday. But, of course, today is Sunday, so that means we're sitting in the beautiful iHeartRadio studios with all the fancy flat screen TVs and the fancy feng shui little wall and all that kind of stuff going on here at the studio. So let's begin with that topic of how much you'll really spend in retirement. And first we'll start with the sort of the traditional rule. The traditional rule is that you want to have be able to replace 70 or 80% of your income in retirement. And where that comes from is that when you look at your income or your paycheck that you make when you're working, that paycheck also includes some things that you're not going to have to do in retirement, right? So one of the biggest of those that happens for everybody is the fact that nearly 8% of that paycheck is lost to Medicare and Medicaid and Social Security. All that FICA tax stuff gets taken out of that paycheck. Well, in retirement, you don't have to keep paying into Social Security or Medicare. It's one of those things where if you pay into it while you work, when you don't work and are actually collecting, then you don't have to pay into it anymore. Well, that's about 8% of income. And then generally, if you're doing what you should be doing, and hopefully you are because you're retiring, which means that you must have done something along the way in terms of saving for retirement. So if you're following kind of the 10% rule, which is that as you approach retirement, you certainly want to be contributing 10% of your income towards your retirement accounts. And obviously, if you're younger and can get to that 10% threshold sooner rather than later, then that's going to mean that your retirement has a lot more resources in it than just Social Security. If you're older and just getting started, well, then obviously you want to do more. The reality is, though, that those contributions that you make to your retirement accounts, you would not need to be making those actually in retirement, right? Because if you're retired, and that presumes that you had enough money or you saved enough money along the way to then make that transition to, okay, now I'm going to draw out of my assets. So that's where the traditional 70 or 80%, replace 70 or 80% of your income in retirement and you're going to be fine, comes from is, number one, you don't have to worry about paying the FICA tax. And number two, you don't have to worry about funding your retirement accounts. What that misses, though, is that it misses the reality of those, particularly those first 5 to 10 years in retirement. And here's where people kind of have the trajectory kind of flipped. A lot of people assume that in retirement they're going to be spending more money later on. The reality is that you spend more money early on in retirement because when you're early on in retirement, you're at a younger age. And when you're at a younger age, you can do stuff better or you can do stuff more, right? I mean, that goes without saying that if you're 65, chances are you're going to be dancing the foxtrot a little bit better than when you're dancing the foxtrot at 85, right? So guess what happens, though? If you're dancing the foxtrot and you're on a cruise, well, then that costs money. And so the reality is that you actually wind up spending more money in the first few years of retirement than you do in the latter years. Many people kind of have that flipped in their head, but the reality is that you do, in fact, spend more in the first few years of retirement. So, given that, at the office, when we do retirement income planning and those types of strategies, we talk about that as your free time expense. And your free time expense, depending upon what you like to do, can be a decent chunk of your retirement income. So we encourage you to add in that free time expense. Many people sort of don't think about that or they forget that because the reality is that instead of having to go to the office every day, right? Well, if you're going to the office and you can't go goof around, you go from spending all of your days generating income to having the ability to have all of your days be spending money. That adds to what you're going to need in retirement. Similarly, what a lot of people miss is health insurance and the fact that that does cost money. And for many people, they don't necessarily see when they're working that being a line item in their expenses because it sort of comes out of the paycheck right out of the gate. Or if you're fortunate enough, as the employees at Nelson Financial Planning are, you may still have an employer to fully pay for 100% of your health insurance coverage. Well, shoot, that's pretty cool if your employer pays 100% of your health insurance coverage. That means, though, that when you retire, guess what? Now you are responsible for it. So then that becomes another line item in the budget, if you will, for retirement, which is why our personal view is that if you're going to retire, you've got to look at replacing 100% of your income, and in some cases, depending upon what your hobbies are, maybe even replacing a little bit more, depending upon how you spend that free time and how much that free time expense is for you. So it's important to really ignore some of the more traditional rules out there that says that, well, if you can retire 70 or 80% and retire on 70 to 80% of your current income, then you're going to be okay. We would encourage you really to shoot for 100% because there's a couple of things in there that you don't necessarily see when you're working that will, in fact, be major sources of expenses when you retire. Number one, free time expense was what we refer to it as. And then, of course, health insurance and health-related types of costs. Those are going to be much more out of your pocket than they are when you are working. So some important things to think of and why, when you're thinking about how much you'll really need in retirement, you've really got to be thinking not in those traditional terms of replacing 70 or 80% of income, but rather replacing 100%, and depending upon what your hobbies are, maybe even a little bit more than that. So some interesting comments on how much you'll really need to spend in retirement, and certainly one of those things that you've certainly got to look at that overall picture to make sure that your numbers for retirement and your income planning for retirement hits the mark, to say the least. So anyway, we will take a break. We will slide to the break. We get back from the break. We're going to talk about some of the conversations up in Washington as it relates to 401ks and IRAs. And then, of course, also happy to introduce whatever it is that's on your mind as well here on the program. The numbers to call in, 407-916-5400. Toll free, 1-866-916-5400. You're listening to Joel Garris of Nelson Financial Planning on Dollars and Cents on News Radio 93.1 WFLA.
iHeartRadio is the easy-to-use app for music and radio. Download the free iHeartRadio app today.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back, ladies and gentlemen. Dollars and Cents here on 93.1 News Radio WFLA. This segment of the program, we're going to be chatting a little bit about some of the conversation in Washington that's currently happening, that the folks in Washington are looking at your 401k and trying to figure out ways to encourage people to do more, or perhaps give them a better perspective on what that 401k balance actually means, and to translate that to dollars and then into actual income in retirement. So this is kind of a little bit of a subset, if you will, over an extension of the conversation we were having in the first part of the program, where we were talking about how much you actually will need to spend in retirement, a bit of that retirement income planning. The issue is twofold. Many people don't really understand how a lump sum amount of money translates to income, or what's the right amount of income to utilize or to expect from a lump sum of money. And this comes from the reality that most Americans these days do not have what was the most traditional plan for many decades was in the form of a defined benefit pension plan. And how a defined benefit pension plan works is, well, if you spend X number of years at the company, then you will wind up getting a check a month. Once you retire, you will wind up getting a check a month based upon the formula that was defined in that benefit plan. Well, the reality is, with the advent of 401ks and the explosion of those as the option that employers offer, particularly over the past 3 or 4 decades, you're now only 13% of employers offer a defined benefit pension plan. That means 87%, or the vast, vast majority, have things like 401ks, 403bs, 457s, or the like. So it's very important. The old system, where it was defined benefit, it was really more based upon that monthly amount, and you knew what that monthly amount was going to be based upon the formula that was defined. That's why it was referred to as a defined benefit, because the benefit was defined. Now, with 87% on more of a defined contribution type of plan like a 401k, then all you know is what the money is that's going in and what the balance is, but you don't really have any idea how to translate that to an amount of income. So many of the proposals that are being kicked around in Washington these days are sort of intended to give people a better insight, given this seismic shift in the types of retirement plans that are out there. And so one suggestion out of Washington is that there would be sort of an annual sort of snapshot that you would get that would show you how much income you would get in retirement based upon your current balance. And that's certainly a great idea. I'm always a little worried when government gets involved in providing or ensuring that people get snapshots on their money, because you have to then understand what the assumptions are that they are relying on to make that projection, right? And chief among them is going to be, okay, well, what's your investment allocation going to look like in retirement? The reality is that if you have a conservative, bond-heavy investment allocation, guess what? You're not going to get as much out of that as if you were following a more traditional growth and income approach that still had a portion that was more on the stock side than the bond side. So the problem with that is you're going to get some sheets that are going to be, I would imagine, much like anything, that anytime you've seen the government get involved in this stuff, there's a tendency to present the numbers in the most conservative light possible. And unfortunately, that doesn't give you an accurate picture of what the real amount of income is that you could get if you properly went through the retirement planning and the retirement income planning process. So it's a good idea and concept, but the limitations are what's the investment allocation that the proposal is going to be run at, and what's the assumptions that are going into that. And certainly the other part of it that makes us a little concerned about what they're doing is the suggestion that they're going to bring in more options for annuities to be offered in correlation or in conjunction with a 401k. Well, if you have not heard us talk about the subject of annuities before, rest assured that our opinion on them is not very high at all. We think that they are internally a much more expensive to the investor alternative than just owning directly a balanced portfolio of predominantly large blue chip mutual funds. That, over time, has a much greater record of consistency and performance rather than putting it into an annuity where your expenses are much higher. And so the problem we have with that is that, well, frankly, I think the insurance industry is probably lobbying pretty hard for this because they're trying to make inroads into those 401k dollars, particularly when 87% have now shifted over to defined contribution types of plans. The reality is that that's a lot of money there, and for the most part, it's held by investment management companies. Well, guess what? Investment management companies aren't insurance companies. The insurance companies want a piece of that, and I suspect, given that my understanding of how Washington works, having lived there for a few years early on in my life, that there's probably a lot of lobbying going on so that the insurance industry can start getting into this investment management turf. That's the problem that I have with what on its face seems like a good idea, but anytime you roll out the annuity conversation to the consumer, it really gets expensive and it gets confusing in terms of what exactly the benefits are to owning an annuity. We will keep you posted as this develops, but certainly this is an ongoing conversation in Washington. I get what they're trying to do. The world has changed. Only 13% of employers have defined benefit plans and that guarantee certain amounts of income when you retire. 87% just have lump sums. Most people don't have any idea how much that translates to income in retirement. So the idea and the concept, I think, is good. The problem is that it really it all depends on those underlying assumptions that the government makes, and oftentimes those are going to be spun more on the conservative side of things, which would make the process or the numbers much less than what you should be getting. The other piece of the conversation that they're having relates to minimum distribution rules and being able to fund IRAs. So this part is quite a bit more interesting because this one would have a lot more implications on what you can and cannot do with a retirement account once you either pass away or turn age 70 and a half. We're going to get more into the meat of that, but we're going to take a break. And then when we get back, we'll delve down into those provisions that are being bandied about in Washington these days, and some good, some bad, and we'll explain which one is which when we get back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1. This is Joel Garris of Nelson Financial Planning, talking a little bit about some of the conversations that are ongoing in Washington these days, particularly involving 401ks and IRAs. We talked a little bit last segment about the requirement to get some annual disclosure, converting that lump sum amount of money to an income. I'm always a little nervous when the government gets involved and starts mandating financial proposals, because ultimately they're going to set the assumptions, and oftentimes the assumptions might be quite conservative in terms of how those numbers project on out, which means that they are relatively inaccurate. They seeing how they also change like the year for Social Security and Medicare running short of dollars, and then that like changes, seems like every year in terms of their projection. Yeah, that's what I'm talking about. I don't know that I want the government getting involved with how to project out how my retirement balance is actually going to convert to a income amount. They don't have a history of being highly accurate, but hey, it's the government and they're here to help. Anyway, the other parts of this conversation that are floating around in Washington are some of which would be helpful, such as being able to still contribute to an IRA even though you're past the age of 70 and a half. If you're still working, being afforded that opportunity that you do not have now would certainly be helpful to boost retirement savings for those folks that are still working along and not fully retired and are not generating all of their income out of their retirement assets. Another item that's on the table is reducing down the amount of the required minimum distributions from the 401k. Certainly that would be very beneficial to folks that are forced to take money out of their account and pay taxes on it, particularly if they don't necessarily need that income. Another proposal that's floated around is one that is that you hear a lot of, trying to figure out a way for small businesses to sort of band together to offer 401ks and the like. That's always been a tough threshold to offer employees those types of retirement plans, because a 401k requires a lot of testing, a lot of administrative and IRS filings that are required, which means then that they are a bit more costly in terms of how they play out. Another item that is being kicked around, and this one does concern us quite a bit, and that's what happens when you inherit an IRA. And right now, when you inherit an IRA, it's actually can become a pretty lucrative proposition for the beneficiary, because they can leave that money continuing to grow on a tax-deferred basis and basically take out a small amount of a required distribution, thereby allowing the balance of the account to continue to grow on a tax-deferred, tax-compounded basis. That's certainly a great feature when you do inherit an IRA, and obviously an approach that we certainly advocate people to take advantage. Why would I cash out that IRA and pay the fullest amount of taxes on the balance when I can let that thing continue to grow and defer itself and ultimately be a very powerful source of my own retirement income once you get to retirement. The proposal in Washington would in fact cap how much you get to do that with. And so what's being floated around in Washington, we really don't like this at all, because it means then that your taxes are going to be higher if you inherit a decent size IRA. And with so many people, over the past 3 or 4 decades, putting their money into these types of plans, then you certainly do see these lump sums in IRAs and retirement accounts really building up. Well, what this proposal in Washington would do is it would basically say, if any amount in that account, if the balance is over $450,000, then the excess above $450,000 would have to be taken out and paid as tax for over a 5-year period of time. We think that's a very bad idea, and certainly hope that the folks in Washington aren't serious about that, because then that just accelerates the amount of taxes that you have to pay when you inherit an IRA, and it also means that there's going to be less of it available for you to continue to grow on a tax-deferred basis. So that's one of the ones in particular we're watching that could have some wider spread implications, particularly not just from a tax planning perspective, but also from an estate planning perspective, if you are required to pull that money out within a 5-year period of time. Obviously, that means the taxes on you will go up, and you've lost the flexibility that you previously had, being able to stretch out that IRA over the rest of your lifetime. So stay tuned on that one. Hopefully that one does not have much legs, but that is, in fact, what they're talking about in Washington. And the folks in Washington certainly love stuff when it generates revenue to them so they can go and spend it. I mean, that's part of why that proposal is being looked at, because the trade-off is that they want to make the tax cuts that are currently scheduled to expire in the year 2025 to make those tax cuts permanent. So they got to figure out some other ways in which to generate revenue. I don't like them hitting retirement assets and making people pay a big chunk of taxes on them sooner rather than later. Unfortunately, that's the Washington mindset these days. Speaking of mindsets, one of the conversations that we have quite a bit in the office is about the amount of your assets that should be allocated internationally. And right now, given the performance of the U.S. market, particularly the U.S. market versus the international markets, it's easy if you're looking at your investment allocations to say, man, that international or that global fund, that has just not been performing for me over the course of this year, and I want to dump it. Well, before you get to that point, we want to share with you some perspective. And so when we get back from the break, we will share some perspective on the numbers and perhaps why you don't want to just wholesale dump that international allocation that's in your portfolio. So stay tuned for that here on the program. This is Dollars and Cents with Joel Garris, News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. This is Joel Garris. And during the break, Frank sent us an email, which actually has a great point. If the government does do the IRA change, and the change that we were talking about before the break was this notion that they may only allow you to stretch IRA balances that are $450,000 or below, and so the excess amount over $450,000 is going to have to be taken out and paid taxes on a 5-year. Would a move to a Roth IRA be better in the long run? Just a thought. Frank continues, do not like Roth, but would it reduce the overall long-term tax? That's a fair point, because that could be a situation where we would perhaps become fans of a conversion, because generally we're not fans of a conversion because I hate sending money to the government that I don't have to. But depending upon where your tax bracket was falling, whether your Social Security was already taxed or was going to be taxable with that additional income, you could certainly see where an analysis could be made as to whether do you take your balance above $450,000 in your IRA and start to convert it. Fair point. Yeah, we'd want to run the numbers on that, Frank, but that would be one potential strategy in reaction to whether these conversations in Washington actually occur or not. My suspicion is, given that it's a midterm election year, that probably none of this will come to fruition. But the fact is, that they're sort of circling around these concepts, and obviously we're watching what happens, and because it's going to have, as it always does, a impact on how you plan ahead, both not only from a tax perspective, but also from an estate planning perspective. So stay tuned on that, Frank, as we know you will. The other comment we were making before the break is on the international side of things. The international side of things is certainly not had great performance of late, particularly this year. You may be tempted to throw the towel in on it. We would encourage you to not do that. That's part of being diversified, is that at any given point, not everything is going to be moving in the same form and fashion and lockstep. The very nature of diversification is that there are things that are going to be doing better than others. Right now, a domestic, U.S.-focused, more growth-oriented type of investment is going to be doing better than an international one, hands down. But I think for a little perspective on that, consider this, and that is how much the U.S. economy's share of global GDP is, in fact, shrinking. Back in 1960, the U.S. amounted for 40% of global GDP. Today, because the overall global economy has increased so much in places like Russia and China and South America, and even parts of Africa have all started showing some level of economic growth and economic output as well, that number that used to be 40% in 1960 is now down to 22%. So that means that 78% of the global GDP, or the global economy, is in fact happening in countries other than the U.S. So we think it's important to still own 20, 25%, somewhere in there on the international side of things, particularly if you want to have a diversified portfolio, because you've got 78% of the global GDP happening outside the U.S. So just some perspective on those numbers. Another number for some healthy perspective on the current state of the markets. Last week, the markets sort of breathed a sigh of relief as it relates to the tariff side of things, because there was a conversation of getting back to the table with the Chinese to discuss that further. So far, other than, a story here and there does not seem to really be any big economic impact on this tariff conversation. Of course, I think the U.S. is in a position of a relative strength in the conversation, simply because right now our economic growth is at 4%. So the markets last week were relatively positive. What was perhaps the most interesting number that I saw during the course of last week was actually a business sentiment number that had the highest reading since 1983. So stop and think about that for just a second. 1983, that is all the way back to Ronald Reagan's time. So when your business sentiment indicators are as positive or as high as they've been since Ronald Reagan, that to me is a interesting sign of exactly what's happening out there in the economy, in the markets, that businesses are feeling good. When businesses feel good, they spend money, and ultimately consumers spend money as well. So one of those numbers that we saw this past week in terms of the overall market and the economy that we wanted to share with you on the program this morning, you got consumer, you got a business sentiment readout that is the highest since 1983. That tells a much stronger story than kind of the hysteria that the mainstream media likes to generate whenever it talks about the economy or the markets. Remember, bad news always sells and gets people's attention much more than good news. And so it's very hard to find these nuggets of news that are, in fact, quite positive in terms of the overall economy and the overall state of sentiment and spending in the country today. So certainly some interesting things there. Looking ahead for the week ahead, there's some additional economic data coming out this week, so we'll see how that plays out. It's funny, here we are getting into the back half of September, which means that the third quarter going to be wrapping up pretty soon, so we'll start to see a lot more economic data and then, of course, corporate earnings as well. So a lot of that coming out in the weeks ahead, but certainly an interesting number as it relates to business sentiment. Certainly a strong number across the board. So those are just some of the things to think about in terms of what's going on out there. Certainly this conversation about the international markets and their relative performance, I think, will continue to weigh on people's mind, along with whatever the folks in Washington do. The folks in Washington, certainly some of the ideas in terms of getting additional information out there about 401ks is always good. I'm always concerned about the assumptions that go into any projection that the government makes. I'm not sure that that's ever going to be totally accurate, and certainly it is based solely upon the assumptions underneath it. The biggest of those proposals that are getting kicked around is really potential changes to the required minimum distribution rules. Some good in that to move out or shift those distribution rules to maybe require less to be distributed out. That would obviously be good. Being able to be over age 70 and a half and make a contribution to an IRA if you're still working, that would also be good. What would not be good is if they started limiting how much in an IRA can get passed to the next generation, and for that passage to enjoy that stretch IRA type of provision that allows that money to continue to grow on a tax-deferred basis for the rest of your life. When you inherit an IRA, certainly very powerful stuff. But the notion that they'll cut it off at $450,000, and then the amount above that you would have to take, or your beneficiaries would have to take out over a 5-year period of time. Don't really like that suggestion at all, because that triggers additional tax and also means that folks are going to have to spend money or take money out of an account that they didn't perhaps necessarily need to do that. But you have to understand the impetus or the idea behind it. It does generate tax revenue, and if the folks in Washington are looking to make the tax cuts permanent, then that's where you would look for them to see about trying to find some places where you could generate revenue. And certainly requiring people to take that money out on an inherited IRA over a 5-year period of time certainly generates a lot more tax revenue than letting them spread that out over the course of decades of the rest of their life. So stay tuned on all of that. Frank's email points out a very valid point. Does that mean that the Roth conversion conversation creeps back in? Potentially. We'll have to see kind of how all of this plays out along the way. And obviously, here on the program, that's the kind of thing that we've been keeping you informed of for, probably over 30 years now. So, because that's how long we've been doing this, or at least the show's been on the air. So, stay tuned for more on those developments out of Washington. We did not get to talk about talking devices and smart speakers. I meant to do that. We did not. We ran out of time. We will table that one for next week and talk much more about that on next week's program here on Dollars and Cents. This is Joel Garris. You've been listening to News Radio 93.1 WFLA.
Fees, commissions, expenses, investment costs come in all shapes and sizes. Do you know how much your investments are really costing you? At Nelson Financial Planning, we believe that costs should be a major consideration in your financial plan. After all, the lower your costs are, the more you get to keep for yourself. This is Joel Garris, and I invite you to get educated about your investment costs. Visit NelsonFinancialPlanning.com or call us today at 407-629-6477 to set up a personal conversation to review your investment costs. That's NelsonFinancialPlanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC and FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 93.1 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.